Breaking news has just emerged, with the Chinese Finance Ministry announcing a significant increase in tariffs on US goods. Previously set at 34%, the tariffs have now been raised to a staggering 84%. This move is a clear blow to American companies seeking to enter the Chinese market and is expected to send shockwaves through global financial markets, particularly in the US. In addition to the tariff increase, Beijing has also confirmed that it will be taking the Trump administration to the World Trade Organization, WTO, a move that had been anticipated. The Chinese government has made it clear that it will respond resolutely to any US tariff increases, particularly in light of President Trump's plans to raise tariffs on Chinese imports to at least 104%. This latest development marks a further escalation in the ongoing trade dispute between the two global superpowers. In a striking statement, China has criticized the Trump administration for its apparent reluctance to engage in negotiations, with Chinese state media mocking the fact that other countries are turning to Washington, pleading for tariff relief. Beijing has emphasized its support for multilateral trade efforts, where fair rules apply to all nations. This stance has garnered some sympathy, particularly from developing countries in Southeast Asia, which have been adversely affected by US tariffs. At the same time, Chinese President Xi Jinping has indicated that China plans to increase trade with its neighboring countries, many of which are also facing US tariffs. This strategy appears to be an attempt to mitigate the impact of the ongoing trade war and to turn the situation into an opportunity for regional economic growth. As this story develops, there has already been a noticeable impact on global markets. The German stock index, the DAX, experienced a sharp drop, and US stock futures have turned lower following China's announcement. The economic ramifications of the growing trade tensions between the US and China are significant, with experts warning of potentially severe consequences for the global economy. The scale of US-China trade is enormous, with both countries relying heavily on each other for goods and components. Tariffs placed on goods from one nation can disrupt manufacturing processes in both countries, affecting industries worldwide. American companies, which rely on Chinese components for products such as cars, are already feeling the impact. Despite President Trump's assurances that American companies will thrive, the reality is that higher tariffs on Chinese imports will increase production costs, making goods more expensive for consumers. Further updates indicate that China's Commerce Ministry has added 6 US entities to its unreliable entity list and 12 US entities to its export control list. These moves are part of China's broader strategy to target American companies and individuals that are seen as undermining Beijing's interests, such as those involved in trade with Taiwan or Hong Kong. Although the tariffs imposed by China cannot fully match the US tariffs on Chinese goods, China has strategically targeted industries that could hurt US businesses, particularly in key sectors like agriculture. Analysts predict that Beijing may continue to increase pressure on the US by targeting more sectors, particularly if Trump intensifies his tariff policies. Unlike other countries, China has the advantage of a robust domestic market, allowing it to weather the economic fallout from these trade tensions more effectively. The Chinese government remains confident in its ability to endure, despite the impact of US tariffs. This dynamic gives Beijing a level of resilience that other nations, particularly in Southeast Asia, lack. As the situation evolves, it's clear that the US-China trade dispute is far from over, with both sides continuing to escalate their measures. The global economy will likely continue to feel the reverberations of this trade war for the foreseeable future.